Welcome to Managerial Accounting. And today is Tuesday, November 8th, the fall 2022 semester. As you can see on the screen, we are going to be starting chapter 25 today. So the chapter 25 pre-quiz should be submitted by the end of the day. Because we finished chapter 24 last class, the chapter 24 problem is also due today. And as you've known since the beginning of the semester, the annual report project, the full project, is also due today. So anyone who submitted a draft, feedback has been sent on those. If I was delayed in getting feedback to you, then you have an additional few days to submit that report. But if you did not submit a draft already, then your project is due today. So we'll be covering chapter 25 this week. So the chapter 25 exercises are due on Thursday. And as we've already discussed, the chapter 25 is the final chapter on the third exam. So we have a review session scheduled. Obviously, that's optional. It's not at our regular class time on Monday from 9:30 to 10:30 in the morning. If you are able, and that will be on Zoom. If you are able to, it's okay. If you are able to join us on Zoom on Monday, please sign up in Starfish. You go into the courses area and you should see a link there under by our course. It says something about drop-in review session. Make sure you're signing up for the Business 1520 drop-in review session. It's labeled for exam 3, and that's the one that's next Monday. As I've said for the other review sessions we've had earlier in the semester, please do not skip some other class to come to that review session. That's not appropriate. As long as anyone is there, we will hold the review session and I will record it. If nobody signs up for the review session, if nobody's there, then I may or may not go through the practice exercises. I'm just talking to myself on a Zoom recording. So if there is no review session and you're working on the practice set and have questions, I would be happy to address those. I'd be happy to meet individually with you at a time that is suitable for your schedule. But as long as anybody's there on Monday, my expectation is that we would go through the practice set for exam 3. And then on Tuesday, the chapter 25 problem is due. And then as we go ahead, then the exam 3 is due on the Sunday before Thanksgiving. So I'm talking about this now, even though we haven't even finished chapter 25, because as you're looking ahead, and I'm sure people are looking forward to the week off at Thanksgiving, but you need to complete the exam 3 before you take off for the break. So if you are, say, planning to leave campus on Friday to go home or go someplace else to spend that holiday week, I would really encourage you to take the exam on, say, Thursday before you leave. It is not a good idea to take that week off and then come back and try to do the exam. So it is officially due on Sunday the 20th, but you are welcome to do it anytime after you complete the work. The final assignment for chapter 25 is, of course, the problem, and that's due on Tuesday the 15th. So you could take the exam on Tuesday, Wednesday, Thursday, and still have it out of the way before you are off campus or tuned out of accounting for the week, even if you're still going to be on campus. So hopefully I'm clear about that. And once we finish chapter 25 on Thursday, we should have time during class this Thursday even to talk about the exam. So definitely before the exam, we'll be talking about it, looking at it like we normally do. And this exam will be just like the first two. There's a mix of multiple choice and exercise free response kind of questions. And there's a practice set. There's a time limit on the exam. So everything you've seen in the first 2 exams will continue in the third exam as well, in the fourth. So any questions about that? What's coming up, what's due, anything like that? Okay. So last class, we finished chapter 24. Is there anything you want to talk about from chapter 24? Everybody's doing okay. So we will keep moving ahead. And we'll go to chapter 25. So as you can see on the screen, chapter 25 is about differential analysis and product pricing. And I know there have been many times earlier in the semester where economics has come up. And I know at least a couple people in here either have taken some economics coursework or are currently taking an economics class. So for those of you in that situation, what we talk about with differential analysis may sound a little bit familiar to you. And we'll also in this chapter be talking about product pricing. So our first learning objective and the first few exercises are preparing differential analysis reports for a variety of managerial decisions that we might be called on to make in the workplace. So how do we use accounting information to help us make those decisions? Then, as I said, we'll be talking about how do we price our product? What's the right or the correct, the best price for our product? Talk about a couple different ways of pricing products. I want to show you, I should have done this before I left Brightspace, but I want to show you in Brightspace someplace up here to the reference materials. So in the reference materials folder, there is a link to a video. And good, it still works. It worked at the beginning of it, or I fixed it at the beginning of the semester. I was hoping it would still work. I would ask that you watch this video. It's a YouTube video. The link is right here in the chapter 25 reference materials folder. I'm not going to try to show that to you during class, but I would like you to see it. So please make a note if you have a to-do list to watch this video. It's only something like 6 or so minutes long, if that. And it is relevant and important for one of the other topics we're going to discuss in this chapter, which is learning objective 3, describe and illustrate the managing of manufacturing bottlenecks. So that video speaks directly to that learning objective 3. And I would suggest that in the 6 or so minutes that that video lasts, he does a perfect job of illustrating managing manufacturing bottlenecks. I'll talk about a couple other things related to that on Thursday as well. But today our focus really is going to be on differential analysis. So we'll start with talking about what is that anyway? What does it mean if we're doing a differential analysis? So I already mentioned this in terms of economic decision making, and I will tell you that this topic is the main focus of this chapter. So I know that the chapter title covers 2 things, differential analysis and product pricing, but my focus, the most important part of this chapter, is differential analysis. It is the first 7 exercises in this chapter. So it's going to take up the majority of our time and work for this chapter. So if you've taken economics, if you're familiar with economic terminology, we sometimes think of differential analysis as marginal analysis. You can see a third term up here on the screen, incremental analysis. What we are looking at then specifically is what would change if we made this decision. What changes would happen? So we talk about marginal analysis in economics. We're talking about what happens if we add, say, 1 more unit of production, or if we subtract 1 unit of production. So we're not talking about averages. We're not talking about the difference between producing 0 and 10,000 of something. We're talking about for example, right now we're producing 10,000 units. What would happen if we produced just one more? And so what we're looking at from an accounting perspective for the majority of this chapter, as I said, is looking at what would change, how much additional revenue would result from producing that, in my example, one more unit, how much extra revenue, that's the marginal or differential revenue, how much more would we bring in sales if we made one more unit, and comparing that to, and how much is that one more unit going to cost us? And so from a decision-making standpoint, just in the abstract, before we start looking at actual situations and looking at hard numbers, it seems pretty obvious, pretty evident to say, well, we'd make that one more unit if the money it brings in would more than make up for the extra cost, right? So it's really a cost benefit analysis that we're doing. It's going to cost us X dollars more to produce that 10,000 first unit, but we're going to be able to sell it for Y dollars if Y dollars is greater than X dollars. If we bring in more revenue than it costs us to produce it, the result should be clear. Yes, we want to do that because that would improve our profitability. And so one of the topics that's going to come up again in this chapter, something we've talked about in earlier chapters, is recognizing which costs are fixed and which costs are variable. And so we know, for example, if we add one more unit, if we go from 10,000 to 10,001, our fixed costs are going to remain the same. And our variable costs are going to increase, right? So our end result, the final decision should be, will our revenues increase? Can we sell that unit, that one more unit, for more than the variable cost to produce it? So in that case, we're ignoring the fixed costs because they don't change, because we're already incurring those fixed costs because we're making 10,000 units. So before I move on, then just one last point. So we are not talking about, should we produce 0 or should we produce a whole bunch? The assumption is we are already producing, and should we produce more or should we produce less? What would change if we change from where we are right now? This is different than if you've taken microeconomics or are taking microeconomics. In that class, one of the topics that's covered is the shutdown decision. Should we shut down or keep producing? That is not what we're talking about here. We are talking about, we're already producing. What's the right number of units to produce? Should we produce more or fewer than we are producing right now? So as we turn to our first exercise, and as you saw in the learning objectives, our first really 7 exercises are going to be different types of decisions that a manager could be called on to make about the production or sales of the company. And we're going to be using this concept of differential analysis. I'm just going to tell you up front, there are a couple exercises that seem to violate some of the guidance I'm going to give you. And it will, I hope, become clear to you why they're presented the way they are in the templates, that maybe it's not ideal, but there's a reason that they give you more information than they need to. And in some cases, I will, as you heard me say earlier in the semester, there may be some cases where I say, this is not how I would do it. I would present it differently. Here's how I would make it different. And usually that comes from a position of efficiency, of trying to give the right amount of information, not so much that we cloud the big picture, but not leaving out essential information for that decision-making process. Because again, as you've heard me say many times throughout the semester, and those of you who had me for financial accounting have heard me say many, many times, the whole purpose of accounting is to aid decision makers in whatever decision they are trying to make. And so the information we give them should be the very best information to inform that decision, no more and no less. Questions about that brief introduction to the chapter? All right, so let's go to our first exercise. Hopefully at this point, everyone has your chapter 25 exercises open in See Now, and we're going to start with number 1. You know that you have access to the PowerPoints. The PowerPoints usually are very helpful, and they provide their own examples. At this point, I don't plan to go back to the PowerPoint through this part of the chapter, through the first 7 exercises. We've outlined the concept of differential analysis, where we're really only looking at what will change. And as we go through these exercises, of course, I'll be throwing in some additional information, but I don't think we need to have that outline. But if you want to see it, you know that the PowerPoints are available on the textbook resources website. There's a link to that in Blackboard, or excuse me, in Brightspace. Excuse me. So let's take a look at our first exercise. Laredo Corporation is considering new equipment. The equipment can be purchased from an overseas supplier for $120,000. The freight and installation costs for the equipment are $1,500. If purchased, annual repairs and maintenance are estimated to be $2,200 per year over the 6-year useful life of the equipment. Alternatively, Laredo Corporation can lease the equipment from a domestic supplier for $25,000 per year for 6 years with no additional costs. And we are asked to prepare a differential analysis to determine whether Laredo should lease or purchase. And I need to stop there just for a minute and explain one thing that one thing that is missing from this chapter. And it's something we will address in the next chapter, so next week. Chapter 26, the title is Capital Investment Analysis. And so this exercise talks about a piece of equipment that has a 6-year estimated useful life. In my opinion, they do a bit of a disservice with this exercise. And I know I'm the one who chose this exercise, but it gives me the opportunity to talk about this. I think other than what I'm about to talk about, this exercise is still appropriate and important to think about. So one thing that is missing from this analysis is something that you may have already talked about in financial accounting. If you had me for financial accounting, it's definitely something that we talked about. And that is the time value of money. The time value of money. So in this chapter, all of the exercises we do are somewhat short-term in nature. I'm just going to call it short-term-ish, because 6 years, like in this exercise, to me goes a little bit beyond short-term. And I'll illustrate that with an example for you. So if you are given the choice of $100 today, if I say, I'll give you $100 today, or I'll give you $100 next week, which one would you prefer? Would you rather have it today or next week? What do you think? If I give you the option, I'm going to give you $100. Would you rather have it today or next week? Which one would you take? Today. If you're not sure, if you're like, well, it's the same thing as long as I have it before Thanksgiving or before I start Christmas shopping on Black Friday or whatever. If you can't see that because the time frame is too short, what if I said, I will give you $100 and I can give it to you today, excuse me, or next year. I think at that point, it becomes much clearer. You'd rather have it today, right? You can have the use of it for an entire year, or you can wait 1 year and take the risk that, I might forget, or, I won't be with the college at that point. And so, how are you going to collect from me? But if you're still thinking, okay, it's still the same $100, put it in the context of this exercise where they're saying $100 today or $100 6 years from now. And at that point, it should be very clear exactly what I mean by the time value of money. A dollar spent today is not equivalent to a dollar spent a year from now. As a business, you would not spend $1 today to get $1 back in revenues 1 year from now, because those are not the same dollar. And given that we're looking at inflation, I just saw a report the other day, inflation on food, which, everybody's buying, is over 10% right now. So what you could buy with $1 today, next year, it might take $1.10 to buy that same quantity of whatever. So, excuse me, in these exercises, I am warning you up front that we ignore the time value of money, and it really cannot be disregarded in this context. If we're talking about something that happens in the same year, it's much less important. But when in this exercise, we're talking about a decision where some of these cash flows are 6 years down the road, it is not appropriate to treat a cash flow at the beginning of the project the same way as a cash flow 6 years from now, because of the time value of money. But for what we're doing in this chapter, we haven't covered in this class, we haven't covered time value of money yet. So I need to say that, because in the next chapter, as we're talking about time value of money, you might be looking at me saying, well, why didn't that affect what we talked about in chapter 25? I'm telling you, it does, but we don't need to complicate the topic for this chapter. But in reality, we should be bringing both of those things together. All right, so just bear with me. I'm telling you, for this chapter, we're going to suspend reason. We're going to suspend the time value of money and assume that a cash flow of $1 today is equivalent to a cash flow of $1 6 years from now, even though that doesn't make sense. So in the differential analysis, the concept is we take the 2 or more scenarios to think about how decision making works. If you have a decision to make, if you are trying to determine how to move forward in any area of life, including in a business, in the workplace, the first thing that you might want to do is recognize that there is something that needs to be decided and brainstorm ideas that might help to address that, whatever the issue is that you've recognized. So you recognize there's something we might be able to improve or change to make our business more efficient, more profitable. We sit down, we make an exhaustive list, which means we list all the possibilities, everything we can come up with, without trying to assign value or judgment to them. We just say, maybe this would work, maybe that would work. We make a whole list. Once we have exhausted all the things we can think of, we then start looking at the list critically and saying, okay, which ones of these make sense? Which ones of these, sound good, but it's not feasible for us? And in the exercises we are doing in this chapter, we have narrowed all of these decisions down to just 2 options. So part of the work has already been done for us. They've already come up with, as you can see in the first sentence, hey, maybe we should buy a new piece of equipment. Well, what are our options? They've listed all of the options that will meet their needs or that might meet their needs. And they have narrowed those down to the 2 best options. And that's what we're looking at here. In a real world scenario, it is certainly possible that we would be comparing more than just the top 2 options. But we simplify things for our class to say, this is it. These are the 2 options. Which one of these 2 are we going to choose? So the concept of differential analysis means that we are only looking at the things that are different between those 2 options. So if we were to say, for example, that we can buy the equipment from 2 different suppliers and the equipment costs the same amount from both suppliers, that's not a cost we should include in our analysis because it's not different. If we are saying we need to buy one of these and they cost the same, we're not considering how much it costs because we have to spend that money and the price for each supplier is the same. That's not the case for this exercise. All of our setups for these first 7 exercises, I think every one of them, if I'm recalling, has the setup that looks very much like what you see here. Here's the information for alternative 1. There's a second column for the information. These are in dollars and negatives and positives, dollars of impact. Here's the information from alternative 2. And then the third column is we identify one of the 2 alternatives and say, what's the difference between these 2 columns? And if it's in favor, so you can see in this exercise, it says alternative 2. So if the difference is in favor of alternative 2, we want to show that as a positive. And if it's in favor of alternative 1, we want to show it as a negative. That will allow us then to simply add this column. And if this dollar amount at the bottom is positive, we know it favors alternative 2. If it's negative, it favors alternative 1. It's important that you pay attention to what the title is or the heading on that third column, because there's no reason that they could not have said, this is the differential effects for alternative 1. So we have to make sure that we are following the way the columns are already labeled. We are going to be using negatives and positives in this exercise, in this chapter. So we're given the information first for if we purchase the equipment. So let's do this middle column first. The middle column says, what if we buy the equipment? Well, the purchase price would be $120,000. And if we buy the equipment, we would have to pay the freight and installation of $1,500. And if we buy the equipment, we would have to pay, because we would be the owners of the equipment, we would have to pay the annual $2,200 in repair and maintenance. That's the estimate each year for the 6 years. And so repair and maintenance for the 6 years. Whoops, missed a button. $2,200 a year for 6 years would total $13,200. But if we buy the equipment, we don't have to lease it, and so we can put a 0 in there. So the total cost, if we add the numbers, the figures in that column, the total cost of the project, if we buy the equipment, would be $134,700. Upfront cost, repair and installation, or sorry, freight and installation, and then the repairs, which, as I already pointed out, are spread out over 6 years, but we're treating that as if there is no time value of money. So $1 spent today is the same as $1 spent 6 years from now, even though I want you to recognize that's not exactly true. So we didn't show any revenues here. We've only showed costs. Why is that? Well, the assumption is that the equipment would yield the same revenues, would lead to the same production and sales, whether we lease the equipment or buy the equipment, we get the same result. And so it's not part of our differential analysis because the revenues are not different, whether we lease or buy the equipment. Something that's not included here under the buy the equipment option is it doesn't tell us how much the equipment would be worth at the end of the 6 years. So we have to assume, because it doesn't give us any other information, we have to assume that what they're saying is at the end of 6 years, this equipment has no value to us. It just has to be thrown out. It has to be scrapped. But ideally, you know, at the end of that 6 years, that equipment would have some value, even if we just sell it as scrap metal, it has some value. But again, we have to go with the information that's provided. I want you to be thinking about that because the chances of it having zero value is probably pretty slim. If we could sell it at the end, that would be a revenue associated with buying the equipment. If we lease the equipment, we don't own it. And so there is no residual value, no end value. At the end of 6 years, the equipment would just go back to the supplier and we would have no more stake in it, right? And so it is a little bit troubling that they don't address the idea of a residual value here. I don't want you to ignore that because it's most likely it should be in there. So we know the total cost of buying the equipment and we know why revenues weren't included. If there was a residual value, that would reduce the total cost, right? It would give us some money back at the end to reduce the total cost. The other option, remember, was to lease the equipment for $25,000 a year for 6 years. Well, if we lease it, we're not buying it. We don't have to pay for freight and installation. We don't have to pay for repairs and maintenance because we don't own it. The company that's leasing it to us is going to provide that repair and maintenance. How do I know that? Because it says here with no additional cost. So if we lease the equipment, we pay $25,000 a year, and that covers all of the rest of the costs associated with owning this product, this equipment. So in favor of alternative 2, if we buy the equipment, we pay $120,000 for it. We have to pay the freight. We have to pay the repairs and maintenance. But we don't have to pay the lease, so that saves us money on the lease. The net difference then is we save $15,300 if we buy the equipment rather than leasing it. And so what would our answer be? Should we lease the equipment or should we buy it? We should buy the equipment, assuming the information we have here is all complete and correct. I pointed out to you a couple things that really seem like they should be different, including we are treating the $120,000 upfront cost as equivalent to $120,000 spread out over 5 years. And then the 6th year is on top of that. So we also, as I pointed out, whoops, got an extra 0 in there. The $120,000 that we spend on that equipment, as I already pointed out, we probably should have at least addressed the idea of a residual value. Since we own that equipment, it might have some value at the end. Other considerations here. So remember, we based this on $2,200 a year for repair and maintenance. Well, if it turns out that that was too low, and we end up spending more than repairs and maintenance, how much more would it take to have this $15,000 just evaporate, right? Over 6 years, if it ends up it's $4,500 a year instead of $2,200, we've just lost money. Where if we lease the machine, the equipment, it's not our responsibility to fix it. The company that leased it to us, the domestic supplier who leased it to us, is responsible for any of those repairs. And so if it turns out there are more repairs than we anticipated, it could pretty easily end up eating away at that differential effect that makes it more favorable for us to buy than to lease. So we are taking some additional risk by buying it instead of leasing it. But again, given the information we have, that is the best decision. But you'd want to take into account the risk. So, what if we're wrong? Any questions on that? So definitely a place that we would want to use the possibility of differential analysis. What would be different if we did A instead of B, X instead of Y? Exercise 2 is differential analysis for a discontinued product. As we're considering, should we continue selling that product at all? We may do a differential analysis to think about, to quantify, to put it, in front of us in numbers. What would the impact be of discontinuing this product? A condensed income statement by product line for Warwick Beverage Incorporated indicated the following from Mango Cola for the past year. And so you can see there, it's a multi-step income statement. Sales minus cost of goods sold gives us our gross profit or gross margin. We then subtract our operating expenses to get our operating loss. I've already reminded you earlier in class, at the beginning of class, about the impact of fixed overhead. So the assumption that we're making here is that if we eliminate making the Mango Cola product, our fixed costs would still remain the same. We would just have to spread them out over fewer product lines. And I don't know what other product lines this company sells. It doesn't really matter, other than to recognize this isn't our only product. And so we're not deciding, should we shut down or continue production? The decision is, should we continue producing this product, or should we discontinue that product and keep the other ones? In economics, and I have this feeling that I may have used this term in this class before, but so I may be reviewing something, or this may be new information for some of you. In economics, there is a term, ceteris paribus. Does anyone know what that means in economics, or out of economics? Does anyone know what that means? Ceteris paribus means all else equal. In other words, everything else stays the same. So we can make a change. We can make a change, but without impacting other results or other areas of the company. In economics, when we talk about this concept, we're talking about the modeling that we do in economics. And let's say we manipulate this one variable. What else would, how else, what would we expect to happen? And we assume if we manipulate that one variable, it doesn't change other things in our model. That's really what we're looking at in this exercise. We're assuming that we can discontinue this product and everything else in the company other than this product line would stay the same. So we're not talking about, should we discontinue Mango Cola and then we could take that extra production capacity and make more of the regular cola or the cherry cola or whatever. So as we look at this analysis, we're looking at, we're assuming we can discontinue Mango Cola without having an impact on the other product lines, either increasing or decreasing. Excuse me. It is estimated that 30% of the cost of goods sold represents fixed factory overhead costs, and 25% of the operating expenses are also fixed. Because Mango Cola is only one of many products, the fixed cost will not be materially affected if the product is discontinued. So exactly what I just said. It's a leap year, and we are asked to prepare a differential analysis dated February 29th to determine whether Mango Cola should be continued or discontinued. If an amount is 0, enter 0. If required, use a minus sign to indicate a loss. So if we continue Mango Cola, the revenues would remain unchanged, $15 million. And the profit or loss would remain the same, $3.8 million. Now I skipped over those lines just for a moment because I couldn't just copy those numbers. I have to do a little bit of calculating here based on this information. So if 30% of cost of goods sold represents fixed factory overhead, then the other 70% must be variable, right? So looking at our cost of goods sold, that number right there, looking at our cost of goods sold of 10,800,000. If 30% of that is fixed, then the other 70% must be variable. The variable cost of goods sold would be 7,560,000. I showed that as a negative just to remind us to subtract. Everyone okay with where that number came from? Okay. We need to classify them this way because, as I pointed out with the concept of ceteris paribus, if we eliminate, just because we eliminate Mango Cola, doesn't mean that our fixed costs will change. So we need to know of the costs that are given here, how much of it is fixed. So let's look at the operating expenses. We have 8 million in operating expenses, and we're told that 25% of that is fixed. So if 25% of that is fixed, then the other 75% must be variable. And 75% of 8 million would be 6 million. $6 million in variable cost, variable operating expenses. We now need to know our fixed costs, and there's a couple different ways we can get at that. I'm going to take the easy way because I prefer to be more efficient. So the easy way would be to add together the two costs we already know. Cost of goods sold, 10,800,000, and the operating expenses of 8 million. So our total expenses associated with this 18,800,000, and then subtract the parts that we already know are variable. The variable cost of goods sold, 7,560,000. And the 6 million in variable operating expenses. If you're concerned about it, you can either now add that column to make sure that it does equal the negative 3.8 million loss, or you could have done this, what I would call the hard way, which is go back and now do 30% of the cost of goods sold and 25% of the operating expenses and add those together. you'll get the same answer one way or the other. It's a good way of checking yourself, I guess. So all we've done is taken the information we have here and using terminology that we've learned in other chapters, what we've kind of done is rearrange this divisional income statement or this product income statement to be formatted like a contribution margin income statement. So we've recognized the variable costs separate from the fixed costs, where up here we had them presented in the conventional way that we do for financial accounting, and we have them based on, is it a product cost or is it a period cost? We now have them divided up by, is it variable or is it fixed? And that's the contribution margin format. Other than that, I haven't really changed anything. I've just altered the way I'm looking at the expenses. So is everybody okay with that? Okay. So what if we discontinue Mango Cola? If we discontinue Mango Cola, how much will be our revenues from selling Mango Cola? 0. So if we discontinue it, we stop selling it, there are no revenues, and we lose $15 million in revenues. We lose $15 million in revenues, and that's clearly not a good thing. If we discontinue Mango Cola, will we have any variable cost of goods sold for Mango Cola? No, by definition, if we stop making it, the variable costs just go away. And so that actually allows us to save $7,560,000 in cost of goods sold and $6 million in variable operating expenses. So far, so good. Here is where the sticking point is. We are told that since Mango Cola is just one of many products that we make, our variable costs, our fixed costs are expected to remain unchanged in total. And so even if we are not making Mango Cola and selling Mango Cola, we still have to pay those fixed costs. However, we allocate those fixed costs, and over the past few chapters, we've talked about many different ways of allocating costs for support departments and so on. However, we allocate those costs, we're just not going to be allocating them to Mango Cola anymore. They will have to be reallocated to our remaining products, cherry cola, regular cola, I have no idea, whatever else we make. So those costs don't go away. They just get shifted to our other remaining products. And again, I started this exercise with the concept of ceteris paribus, all else equal. We assume that if we eliminate Mango Cola, nothing else changes. We're not going to expand our production of some other product. The assumption is we're already making what we can sell of those other products. And so how much does it save us in fixed costs if we discontinue Mango Cola? 0. Oops. And so, although we're losing $3.8 million on Mango Cola, if we discontinue it, we'll lose even more. We would lose $5,240,000 because we still have to cover those fixed costs somewhere, just not in Mango Cola anymore. And so, as strange as it seems, when we're losing money by making and selling this product, we're losing money on it. the answer to should Mango Cola be retained is yes. And I'm going to go back up to what we have here and talk about another way we could have accomplished the same analysis based on what we've discussed in earlier chapters. If you've taken microeconomics, this is part of that discussion as well. And let me just put a box around this. This that I'm putting a box around here in the first column is really the critical piece for us. This is, if we do that calculation, 15 million in sales minus the variable costs of 75, 60 and 6 million. We are left with a contribution margin of $1,440,000. Oops. You'll notice that number appears right here as well. What does that mean? Again, using the concepts and the terms we covered as far back as the CVP analysis chapter. This product has a positive contribution margin. The revenues from selling the product more than cover the variable costs. It leaves $1,440,000 to apply toward our fixed costs. So even though the way we have allocated those fixed costs to this product means that we're showing a negative bottom line, a loss on that product, the loss is even greater if we don't sell the product at all. So sometimes that's hard to recognize that Mango Cola is actually contributing to our company because it does have a positive contribution margin. So again, this is another way that we can use this concept of differential analysis to help us make, another type of decision inside the company. What would change if we did this? What would change? It wasn't sufficient in this case for us to just say, Mango Cola is losing money, we should cut it. Because as we can see here, we'd actually lose more money, right? Does that mean that they should be happy just losing money and continue losing money? No. Maybe they should be looking at what else could we do to enhance our margins, to be more efficient, more effective, make more money. But based on this analysis, the answer is not just cut Mango Cola and we'll be fine. Make sense, everybody? All right. My green check marks in there. And we'll keep going. Okay, so I don't know if you guys ever look at the clock in this room. I have no idea if it's normally wrong or if it's only wrong because they did something weird with daylight savings time and they just haven't fixed it yet. I have no idea, but that clock is really wrong. I'll not look at that. Okay. So let's move on then to our next exercise, which is also a decision to discontinue a product. I want to suggest that in this exercise, they also use the concept of ceteris paribus, all else equal, that we can make a change. In this case, they're talking about discontinuing children's shoes. So we make the assumption, based on the information that's provided, that we can discontinue children's shoes and nothing else will change. In other words, the sales and the costs associated with men's and women's shoes would remain the same if we discontinue children's shoes. What I would suggest is this in particular is a case where probably discontinuing children's shoes might affect, excuse me, might affect our sales of men's and women's shoes, because this is how I can see it happening. You are a parent and you have children, and your children need new shoes. And you want, you're very busy, you've got a job, you're trying to take care of the family, whatever. If you need new shoes, you want to go to a place maybe that sells shoes for you and shoes for the kids, so you can take care of all of it in one stop. There's a reason that stores that are department stores are successful, because people like the fact that you can walk in and get all of your stuff, all of your shopping done in one place. Why do you think Walmart sells food and it sells clothes and all of the other household stuff you might need? Because there's an advantage to being a one-stop shop. And so, although for this exercise, we're going to assume that we can discontinue children's shoes without affecting the sales of our men's and women's shoes, I think in reality, that's something that the general manager of Hawkeye Shoes should be considering. Can we actually cut the whole product line and not affect the sales of the other? Back to our previous exercise with the Mango Cola, one thing we did not talk about there, if you stop producing Mango Cola, clearly there were some people buying Mango Cola, right? We had $15 million in sales of Mango Cola. So the question you need to ask is, if we stop producing Mango Cola, are those $15 million in sales just going to evaporate? Are those people going to start drinking water out of the tap that's essentially free? Or are they going to shift their buying behavior and start buying the cherry cola or whatever else we sell? And so in that exercise, I can really see that discontinuing Mango Cola might not be a ceteris paribus situation, that sales of some other products might actually go up to accommodate that. If you want a cola, you might, and you can't get Mango Cola, you might go to a competitor's product if someone else is still making Mango Cola. But you might, if you're brand loyal, especially, you might shift from the Mango Cola to the pomegranate cola. I have no idea. So even though we have to use the information we have here and assume that what they're saying is correct, I'm just pointing out that there might be other considerations. And in this one, I think it's very clear that cutting our children's shoes line is probably not going to increase the sales of men's and women's shoes, but it very well might hurt the sales of men's and women's shoes. I don't know, but my guess is there aren't a lot of people who are saying, oh, they sell children's shoes at that store, I'm not going there because I don't like children or whatever. There are not a lot of people who are going to start buying our shoes because we stopped selling to children. But I can absolutely see that there might be people who stop buying our shoes because they can't get their children's shoes in that same store. Does that seem reasonable to you? Does that sound legitimate that might happen? Seems so to me. But for the sake of this exercise, we do need to use the information that's provided. He has done an analysis, and so he sees that, he sees that the children's shoe line is losing $30,000, while the men's and women's shoes are each have a net positive. And so the overall company's income statement right now shows a net positive bottom line of $35,000. And the manager thinks he's going to discontinue children's shoes. And what it sounds like the manager believes is this is what we'll be left with. $25,000 operating income for men's and $40,000 for women's, a total of $65,000 in operating income. It seems as if the general manager believes that this $30,000 operating loss just goes away. And we're left with only the profitable lines. But we saw in the last exercise that we can't just do that because the fixed costs will not just go away. So this one is a little bit easier than the last exercise because it does already have the variable and fixed costs separated for us. So I'm going to pause the recording and ask you to complete the analysis in letter A. Before I do that, before I pause, I just want to point out one thing to you. It's one of the advantages of this differential analysis is it allows us to focus in on only the things that are going to change. And so we have a ton of numbers up here, and it might be difficult for us to tease them apart as we're looking at it. You get kind of overwhelmed by all the numbers. And so if we pare it down to what we have here in letter A and only include the information that changes, that differential or incremental or marginal analysis will allow us to really focus in on here's exactly what we need to know to make this decision. So you're going to be following the same format as you did in the previous exercise. You can go ahead and answer the questions in part B and check your work. And once you're ready, or if you get stuck, you can restart the recording. I will have my answers on the screen. I'll briefly go through them and then we can move on. So I'm going to stop the recording, restart it when you are done with parts A and B. And so just like in the previous exercise, we shifted things around so they're more in that contribution margin format. So we have our variable costs and our fixed costs separated. We didn't have to do that math. We just had to reorder them. And if we continue children's shoes, nothing would change. We'd still be recording a loss of $30,000 in that segment. But if we discontinue them, we lose the revenues and we lose the variable costs, but the fixed costs would simply need to be reallocated between the men's and women's shoe lines. And so that $75,000 fixed cost would be a direct loss, direct hit to the bottom line, increasing our loss by $45,000. In other words, the children's shoes have a positive contribution margin of $45,000. So even though it looks like we're losing money, we're losing less because it is at least covering some of our fixed costs. All right. So let's keep going. And exercise 4, a make or buy decision for a service company. So that's not really relevant to this exercise, that this is a service company, except we frequently do want to point out in each of these chapters how what we're covering, what we're learning could be applied in settings outside of manufacturing. Even though we're focused primarily on manufacturing for this semester, many of the principles that we talk about, many of the decisions that we have to make as a business are similar, even if you're not making the product. Excuse me. In this case, you almost could argue that they are making a product, but they call themselves a service company. Theater Arts Guild of Dallas, TAG D, employs 5 people in its publication department. These people lay out pages for pamphlets, brochures, magazines, and other publications for the TAG D productions. The pages are delivered to an outside company for printing. The company is considering an outside publication service for the layout work as well. The outside service is quoting a price of $13 per layout page. The budget for the publication department for the current year is as follows. So we've got all of those costs, total of $372,000. The department expects to lay out 24,000 pages for the current year. The publication department office space and equipment would be used for future administrative needs if the department's function were purchased from the outside. So what they're telling us is these office expenses, at least the office depreciation and the computer depreciation, would not go away. Okay. They're going to keep the office, they're going to keep the equipment in the office. They just, because they might need it for something, some other purpose. So those are the fixed costs that we're suggesting are not going to just vanish. So we're asked to prepare a differential analysis to determine whether Tag D should lay out pages internally, alternative 1, or purchase the layout services from the outside. So lay out the pages internally is what they're doing already. So we would not be purchasing the layout work. We would be doing it internally, but we would still have to pay the salaries. These are the numbers that are given up above. The benefits. We would still have the supplies. And we would still have those office expenses. If we do this externally, if we hire someone to do it for us, we wouldn't have to pay those salaries and we would save $224,000. And we show that as a negative, as a cost savings. And we wouldn't have to pay the benefits, so we would save money there. And we wouldn't have to buy the supplies. Whoops, sorry. Wouldn't have to buy the supplies. And we wouldn't have to pay those office expenses, which might be things like utilities, you know, telephone, the printer, whatever. Well, I guess we're keeping the printer, paper, and all the stuff that goes with that. Okay. Now, it's a bit odd the way they have this laid out, that we don't have an option of a box here under office depreciation and computer depreciation, but they do give us those boxes in the purchase layout services column. What I'm going to say is we don't need to include anything there on either line or either column, excuse me, the make versus buy, or the layout internally versus purchase. We don't have to include anything about the office depreciation and the computer depreciation, because from the information we were given, they don't plan to change those. It is not a differential cost. The cost would be exactly the same, whether we make the pages ourselves or we pay someone else to make them. And so we can really leave, these two rows could just be left right out of this analysis. As I tried to point out in the last exercise, we want to make this as succinct as we can. We want to eliminate all the fluff, all the extra numbers that don't help us make a decision, because what it can do is get in the way of seeing what's more important. So if I had made this template, which I clearly did not, if I did make this template, these two lines would just not be there at all. But it does say if an amount is 0, enter 0. So I'm going to put zeros in there, because otherwise I think it's probably going to mark me wrong, not give me my green check marks that I'm looking for. But in reality, we don't need that at all. I think they're in here just to make sure we're considering that. We're paying attention to, hey, why isn't that included here? So our total cost that would be different. Oh, whoops, sorry. We have to put in the purchase the layout part. So we expect to lay out 24,000 pages. And if we have someone else do it for us, they're going to charge us $13 a page. 24,000 pages at $13 a page. The total cost would be $312,000. Again, we haven't, as we said in an earlier exercise, we didn't include revenues here because the assumption is the revenues would be exactly the same. Our revenues aren't impacted. We'll sell exactly the same number of brochures, pamphlets, whatever, whether we lay them out internally or have someone else lay them out for us. And so this is costs only. So I got 320,000 if we lay out the pages internally, 312,000 if we purchase them externally. And so it's a savings of 8,000 if we purchase the layout services. And then we just have a couple questions that we need to answer at the bottom to make sure to show that you understand what's included here. The benefit from using an outside service is shown to be what? Greater. We save $8,000. It's greater than performing the layout work internally. The fixed costs, depreciation, and expenses in the budget are irrelevant to the decision because they stay the same. They're not differential. They stay the same. Thus, the decision this company should make, the work should be purchased from the outside on a strictly financial basis. However, before electing to lay off the 5 employees, TAG D should consider the long run impact of that decision. So we've said that we might be able to use that office space for some other purpose. Might we repurpose those employees to whatever that purpose is? What is that other purpose? Maybe we could just rent out the space and bring in some additional revenues that aren't being included in here. And that would make it even more profitable for us to consider laying out those, or purchasing the layout services. So we want to keep in mind all of the impact of the decisions that we make. Most companies do not take lightly the idea of laying off employees if there's some other purpose that they can use them for. Of course, they want to be as efficient as possible to improve their bottom line, but we should keep in mind the human impact of our decisions as well. Any questions about that exercise? So this is really the make or buy decision. And this same concept could be applied in a number of different areas. This was specifically for a service organization, but you can imagine for a manufacturing company, they might look at, what is it that we're making? Are there pieces that go into this that we could have someone else make for us because they do a better job? It also can be applied in support departments. So many companies outsource their payroll. Why? Because it's more efficient to do it that way, because it's more cost effective. And so they're going to take that into account as they decide, of all the functions our company performs, are there some of these that we should be performing and others that we can outsource? Is someone in here, it might be in my financial accounting class, is someone in here doing Nike for your annual report? Karen, okay. So Karen, I'm going to talk about Nike for a second. So if you don't know, Nike is really not a manufacturer. What do? So Nike had sat down years ago and said, what is it that we do well? They looked for the components of their value chain. We talk about value adding costs. And that was one of the concepts that we talked about back in chapter 15 when we talked about the different ways we can classify costs. So companies should analyze, what is it that we do well? What is it that makes our product more attractive, makes people want to buy our product or buy more of our product? And so they take the value chain, which is all of the steps in producing their product, and they identify within that value chain And again, the value chain is, I shouldn't try to talk and write at the same time. The value chain are all those steps in their process that add value to the customer. And even within that value chain, so even though they might know that some steps add value, it still might make sense to have someone else do that and add that same value, or maybe even more value. So each company should be going through this process of identifying what is it that makes our product special. And the term for that, what makes it special, what do we do better than anybody else? Those are referred to as their core competencies. And years ago, Nike looked at their value chain and they identified their core competencies. And what do you think it is that Nike said they do well? Research and development and marketing. And they recognize that manufacturing is not what they do well. It's not what their core competencies include. And so they don't make the shoes they sell. They outsource that. Anything that is not a core competency is, I'm going to say, eligible for outsourcing. Because if it's not what makes our product special, then we might be able to get someone else to do that for us more efficiently at a lower cost and improve our overall profitability. Or maybe allow us to sell our product at a lower price than we otherwise might. So we generally think of Nike as a sneaker and apparel kind of company, but that's not what they identify as. Here's what we do well. They're good at designing sneakers, and they're good at selling, marketing sneakers. And the stuff in the middle, the actual manufacturing of the sneakers, they have someone else do that for them. They tell them, here's what we designed, make this product. Does that make sense? And so these make or buy decisions are happening at all levels of the company. Nike made the decision that they're going to buy from an external source the sneakers that they sell. They design them, someone else makes them to their specification, and then they sell them with their name on it. All of those support services like supply chain, human resource management, payroll, all of that is potentially outsourceable. That we might be able to get someone else to do this for us in a better, more cost-effective way. And that's this make or buy decision that we started with in this exercise, but it can be used, it can be applied in so many different areas of our company. Does it make sense for us to do this? Or would it be better if we had someone else do it for us? Go to the specialist. Payroll's a really, really good example of that. Questions so far? Can you see again how valuable this can be? Understanding, keeping in mind the idea of, okay, what would be, if we did this, what would change? And is it worth it? We need to be able to sort out the parts that are irrelevant to our decision making. One of the costs, and we're going to see it in this exercise, one of the costs that is irrelevant to our decision making is something called sunk costs. And sunk costs, that term sounds kind of slangy. Sunk costs are costs based on historical decisions and therefore will not change based on our current decision making. Again, we're going to use the concept of sunk costs in this exercise to help us decide whether we should replace a decision or replace a machine or keep the one that we have that we're already using. So sunk costs, costs based on historical decision. It's too late to change them. We already did that. And what we do now is not going to affect those past decisions. A company is considering replacing an old piece of machinery which cost $400,000 and has an accumulated $175,000 worth of depreciation to date. So to use the accounting terms, $400 is the historical cost, original cost. $175,000 in accumulated depreciation. The difference between those 400,000 minus 175, that is called the carrying value or the book value of that asset. In other words, this piece of machinery on our balance sheet right now shows it's worth $225,000. Well, this is a review from Financial Accounting, Chapter 9, the Long-Term Assets chapter. That book value or carrying value of $225,000 does not mean we could sell it for $225,000 right now. We might be able to sell it for that or more or less, or this machine might be worthless. We might have to just throw it away. We might have to pay someone to come take it off our hands, or maybe we could just sell it for scrap metal or whatever. The book value is irrelevant to any decision we make right now, because it does not tell us anything about what decisions we can make going forward. It only reflects the decisions we made when we originally bought this machine. It says it's an old piece of machinery. I don't know when we bought it, 10 years maybe ago, maybe. It's too late not to buy that machine, right? We already bought it. We've been using it for however many years. It's too late to change those decisions in the past. The only thing we should base our decision on today is what happens going forward. So it tells us in the next sentence, the old machine could be sold for $250,000. That is its FMV, fair market value. That number is relevant to this decision, whatever decision we make. If we decide to buy a new piece of equipment, we're going to sell the old one, right? And bring in $250,000. By the way, more review from Chapter 9. If it's worth on our books $225,000 and we sell it for $250,000, we're going to record a gain on our income statement of $25,000. We sold it for more than our books said it was worth. That gain is also irrelevant to this decision making. The only part that's relevant is this. We could sell it for $250,000. The annual variable production costs associated with the old machine are estimated to be $72,500 per year for 8 years. The annual variable costs of the new machine are estimated to be $24,000 per year for 8 years. So this exercise is having us compare for 8 more years. I'll go back to what I said before we started the very first exercise. We really, if we're talking about an 8-year time horizon, we really should be taking into account the time value of money. For this chapter, we're not doing that, but starting next week in chapter 26, we will be talking about how that impacts our decision making. And it really is inappropriate to be talking about an 8-year time horizon and then not take into account the time value of money. Prepare a differential analysis dated May 29th to determine whether to continue with the old machine or replace it with the new machine. If an amount is 0, enter 0. If required, use a minus sign to indicate a loss. So continue with the old machine. If we continue with the old machine, we're obviously not selling it. But if we replace the old machine, we can sell that old machine for $250,000. All else equal, that favors replacing the old machine because we'll bring in $250,000 that we won't bring in if we don't stop using it and sell it. But if we continue with the old machine, we don't have to pay the purchase price of the new machine, which is $550,000. So that will obviously cost more. The fact that we have kind of a trade-in from the old machine brings that down to a net cost of $300,000. Now we have to look at the variable production cost. The old machine is just not as efficient. It costs us more to run it. Maybe we're having some maintenance costs right now, or having to replace parts that are wearing out, things like that. For whatever reason, the old machine is expected to cost us $72,500 a year for the next 8 years. That's a total cost of $580,000. Again, those costs are spread out over 8 years. So the last year isn't really costing us the same $72,500. If we replace the old machine, the annual variable production costs for the new machine are $24,000, a significant savings. It would only cost us $192,000 over the 8 years in operating costs. And so that would save us $388,000. Remember, the net cost after we consider what I'm calling the trade-in of the net cost of the new machine is only $300,000. If we can save $388,000, then the difference between the $300,000 net cost and the $388,000 savings, it's an increase, whoops, extra zero, an increase of $88,000 in our operating income. So the machine, rather than costing us $580,000, would cost us only $492,000. And the difference in our bottom line, whoops, that may be a little too big, huh? Here we go. The difference in our bottom line would be $88,000. So what's our decision then? Should we buy the new machine or not? Buying the new machine would save us $88,000. Should we buy it? No. So what is the sunk cost? So we've already talked about the costs that are not relevant here of the information that's given. $400,000 with a accumulated depreciation of $175,000. That gives us a book value of $225,000. But we're not including that. Nowhere in our analysis did we talk about that book value of the old machine. I talked about it at the beginning and explained why it wasn't important. That then is the sunk cost of what was given. That's the part that we don't need to pay any attention to, because it doesn't impact our decision. So how important is it in this exercise that we can sell the old machine for $250,000? With selling that old machine for $250,000, that's where the savings comes from, right? If we couldn't sell that old machine, if we could only sell it for $100,000, we would say, don't sell it, keep using it. Because even with that $250,000 sale, we only save $88,000. So the $250,000 sale minus the $88,000 in savings, anything less than $162,000 to sell that old machine, it's not worth it to us. We would end up losing money. It would end up costing us more. Now, the new machine might be really cool, might be really fancy. From what I'm told, from what I'm getting here, the new machine's only going to be good for 8 years. And if it's good for more than that, we should be taking into account how much is that new machine worth at the end of the 8 years. These are topics that are going to come up in our next chapter, when we talk about capital decision making. So any questions? At this point, we are halfway through the chapter. Our next 2 exercises are still related to this concept of differential analysis and decision making. But I think this is, given our time frame, I think this is a good point to stop for the day, even though we're just a couple minutes early. So when we come in on Thursday, we'll be able to review the concepts we've talked about today in those first couple exercises, and then we'll go over the last part of the chapter about product pricing. So questions, anybody, before we call it a day? All right, well, thank you for being here.